Most people don't know how to make money using options on stocks. The easiest strategy is covered calls. If you want to produce income, use your stocks to produce income by selling call options on your stocks. This is the easiest strategy to produce consistent monthly or weekly income. And in this video, I'm going to give you the step-by-step process if you're a beginner or even if you already have some experience on how to properly sell covered calls and my tips and tricks for maximizing my income by using this strategy. Real quick on the screen, you will see what I'm going to cover in this short video. I'm going to be covering step by step how to execute covered calls, some real examples and actual numbers of how much money you can make, common mistakes that lose money and things that you should be avoiding if you want to maximize your income, and when to use this strategy, which stocks, and how to properly choose the covered call position. We'll be also talking about opening and closing the position from start to finish so you can understand strategy on a deeper level and make a lot of money using it. Quick disclaimer, this is educational only. I'm not a financial advisor. I'm a guy on the internet who has had really good results and has been trading options for 10 years, but there's a few risks and I will be talking about those risks using covered calls. I'm going to tell you ahead of time that covered calls are very minimal risk, but of course, there is some trade-offs versus just holding stock. So we'll talk about that on a chart a little bit later in this video. Now, here's kind of like the framework for a covered call. Most people own 100 shares of a stock and they just wait for the stock to go up. A covered call actually produces income because when you sell it, that is a position that brings in income since someone else buys a call option and you're the one that sells it. So owning 100 shares of any stock will allow you to do a covered call position. So for example, if you have Apple at $230 per share, that's $23,000 just sitting around. Now, of course, Apple stock can go up. Apple stock pays a small dividend, but for the most part, you're just waiting for the stock to appreciate and maybe get a dividend of like 0.5%. Instead, what you can do is you can leverage your 100 shares and sell a covered call option that gives you income and produces cash flow. So here's what can happen. You can actually view this as an additional dividend, an additional cash flow. So traditional, ETF like S&P 500 only yields 1.4% in dividends per year. That's not going to be that much money. And if you look at other opportunities, most stocks pay, 2 or 3%, even if they're a good paying dividend stock. So instead, if you want to produce income, a covered call position can make 1-2% a week or a month rather than having to wait an entire year. So it speeds up the process of cash flow and it allows you to produce income and have a consistent income. I've been using that for my portfolio here and I've been withdrawing money consistently, and now I'm not so much in the growth stage, I'm more so in the spending and just taking out the cash flow stage. So the portfolio now has reached maturity and I've done this in a reasonable amount of time, less than a decade, and I've retired. So you can do the same exact thing by adding money to your portfolio using covered calls as a strategy to produce income and then, travel the world or, fund your lifestyle with your family, etc. So let me explain to you kind of like the breakdown here in just like 2 minutes. If you own 100 shares, selling someone the right to buying your stock is the way that you produce cash flow up front because they make a payment to you when they purchase a call option and you're the one that sells it to them. Okay, you can think about this kind of like similar to a house analogy. I'm going to make a quick house analogy. Let's say that you have a house that's worth $500,000 today. Someone pays you $5,000 right now, this very minute, to buy the house from you for $520,000 within the next 30 days. The house goes to $550,000. Well, you have to get rid of the house. The house goes up to $515,000. You don't have to get rid of the house. That's how the covered call works. You have a house that's worth 500K. You say, hey, if it goes above to a certain level, I'm going to sell it. I'm going to have to sell it, right? That's how the covered call works. Someone thinks that the stock or the house or that asset will go up. And you're saying, hey, maybe it will go up. I will enjoy the appreciation as it goes up. And then, yes, I'll give it to you. But you owe me some money right now, this very moment, for that potential risk that I am taking. So again, the risk that you are taking is that you will have to sell your stock for more than the current price, right? If it's out of the money, if you sell a covered call that's out of the money, it's higher, then you have to sell at that price. So you will be forced at expiration of that option to sell your stock for more money, for higher than its current price. So if you have a stock, for example, on the screen, you'll see you have a stock at $100, you sell a 110 call option, you must sell at 110 if the stock goes above 110 at expiration. So a stock that you buy for 100, you must sell for 110. So I said that a few times on purpose because I wanted you to be like, that is amazing. I have to sell a stock for higher. Yes, exactly. That's exactly how the covered call works. It's almost like too good to be true. It is such an easy strategy that you get paid for to sell something for a more expensive price. So why is it called covered? Well, it's called covered because you own the shares. You already have the shares. And if exercised, you will be delivering your shares or losing your shares to someone else, right? So this is a safe strategy because you are covered. You have the stock and you are covered in case you lose the shares. And the income mechanism here is the premium that you get paid immediately when you sell a call option. So the cash hits your account immediately right away. You can withdraw that cash and use it for whatever. All right, so let's talk about executing a covered call step by step. But I want to show you a position that I have right now on Walmart, which is a really huge position. And I've been trading Walmart for a long time. As part of my community, I recommended Walmart over a year ago, and it's so far made over 450K, up 58%. And I've done pretty well with covered calls on Walmart, generating consistent income. I have two positions currently on Walmart. One of the positions is a 115 covered call, and one of them is a 105 covered call. But before I go over those specific positions, I just want to say that the step-by-step execution plan for a covered call is simply buying 100 shares of a stock that you don't mind holding. So for me, Walmart was a great stock because of the growth that they have had in their e-commerce side of the business, the stability that they have in their foot traffic, their brand, their location, their pricing power, their supply chain, and much more. So Walmart was a stock I didn't mind holding. And then I chose a call option to sell. And Walmart has actually been going up a lot. Like over the last 1 month, it's up 11%. Over the last 3 months, it's also up 11%. And although Walmart is not traditionally a sexy stock, and a lot of people on YouTube are looking up for more Palantirs and Nvidias and all those more risky hype stocks, Walmart has actually made me and my community a ton of money by just trading it safely. And a covered call on Walmart has provided a lot of income for me. So the expiration days that I typically pick right now are a little bit farther in terms of expiration. So this is a little bit more rare. I am usually going for 30-day to expiration. A lot of my positions are 30 days. But here, because in the Option Retirement Academy, we focus on consistent passive income for retirement, we don't really need to trade too often. So I do typically trade in our Discord community of the Retirement Academy about every single week. Every Monday I have a session, and then I'm trading usually monthly options. But this is a more unique case where you can literally just chill, step back, and sell a covered call that expires in 3 months, even in almost over half of a year here. This option expires in half of a year. And I'll tell you why I did that in just a moment. But when you pick an expiry date, just go for 4 weeks, especially if you're starting a new position. So let's say that you wanted to start a new position on Walmart right now. What you would do is you would just buy 100 shares, and then you would sell a 115 covered call. The reason you would want to go for 115 is it's just right out of the money. So you would collect income, you would start a position. It's a very easy position, very logical position to open up. And at that point, you just wait. You wait until you basically have profits, or if it goes into the money, then you can do some of the stuff that I'm doing right here. So yesterday, I actually ended up trading Walmart and I ended up rolling. So you can see here 19 hours ago, I ended up rolling up my covered call from 105. So I had a 105 covered call, and then I sold a higher covered call at 115. And that's because this position did go in the money. I have made so much money on the stock itself that the covered call strategy that I'm using, I do have to roll it up. I have to take it up because this stock has been in such a bullish move. So I just wanted to show you a more difficult example where the stock goes into the money, and I can just sell it off, by the way. I'm happy because I have it at $71. So trust me, I don't really have to roll it up. I could have just let it sell off. The only reason I'm not letting it sell off personally is because I would have to realize a lot of capital gains, and then I'd personally have to pay taxes. So I don't want to do that. And when I'm working one-on-one with students who are part of the academy, when I'm really doing that tailored, customized approach, I am looking at tax consequences because that's very important. Tax consequences aside, when a covered call goes into the money, you can just pretty much let it sell off. You don't have to hold this position longer than needed. You can just literally let it sell off. If it's in the money and it sells off, you get assigned, that's fine. Because look, if I have it at 71 and it sells off at 105, I'm not complaining. that's fine. Or the trade that I basically am suggesting you, especially if you have the capital to do, if you buy it at 113, then you sell at 115 covered call. So let's say it expires in just 2 to 4 weeks. Basically, then you can get out of Walmart at 115. Let me actually show you the breakdown of what that would look like on Walmart. I'm going to show you like basically how much money is possible to generate via premiums as well. I'll show you actually 3 examples. I'll show you an example of a really short term. I'll show you a little bit longer. Then I'm actually going to show you on a volatile stock, because Walmart is low volatility and you guys probably want growth, especially if you're a beginner, you want to really grow. So let me get through Walmart and then I'm going to show you a more growth example. So December 19th here, okay, if I go for the 115, the amount of premium that I can collect is $97. So yeah, pretty decent, right? $97, it's not a whole lot. And the break even here is essentially $116, right? So if I actually do the math here, I'm going to put up the math on the screen for you to understand what kind of return you're getting here. $116 is how much you will exit this trade for. And then, of course, you're going to buy it for $113.61, which is the current value. And that's going to be about 2.1% return in 10 days. So that's really good, actually. That's really good on a safe stock like Walmart. If you can make 2.1% in 10 days, that compounds to a really good number, because that's less than 2 weeks. On an annual basis, that's going to reach like 50+% on an annual basis if you were able to duplicate this trade. What I do is I teach the methodology of annual return. That's something really important and unique to me. I hope other YouTubers don't start copying that. A lot of them have been through my program, and that's why some of the videos on YouTube may look similar, because I have some people that went through my program. But annual return is something that I have personally really done myself. Basically like a hurdle rate of how much money you are making on an annual basis. And it really personally helps me and the students I work with to understand when to close a position. Is a trade even worth opening up? At what point to roll a position, and all of that more advanced stuff. But the simple story here is 10 days is 2.1%. Now let me show you something that is 31 days, okay? So this is a monthly option. And if I go for 115 here, our break even is going to be 117.12. So the new math, okay, I'm going to put it up on the screen right now, 117.12, right? And divided by the same amount that we have to buy the stock for, which is 113.61. The new rate of return here for 30 days is going to be almost 3.1%, okay? So it didn't really scale as effectively on a monthly basis versus less than 2 weeks. 2.1% is more attractive in 10 days versus 3.08 or almost 3.1% in 30 days. Okay, so that is like the trade-off, and it's interesting to note that shorter-term options can make more money. They do collect more premium. They are more work to manage, but they do collect more premium. However, there's other factors to pay attention to. So anyways, that's Walmart. Let's go to a different stock right now. Coinbase is going to be good. I do have some shares of Coinbase. It is, I believe, a losing position for me. It's very small. I want to point out that anytime I have a losing position, luckily, I'm very good at picking stocks that I believe are risky, such as Coinbase, so I ended up only putting in 0.5%. Like literally, look at that, 0.58% of the portfolio. I just wanted to point out I'm very good at risk management and position sizing to understand what is risky and what's not. Let's go to Trade Coin. I want to just show you the same kind of returns, risk and return analysis that I just showed you for Walmart. So if I go to sell call option here, okay, and then I go for same thing as Walmart, just a little bit out of the money. So I can go for 275, 280 here. Both of these will be good. You know what? Let's just make it simple. Let's go for 280. The 275 strike price and the current price is 272. Excuse me, not 280. We're going to use 275. Let's take a look at that return. The break even is 286.98. Okay, so 286.98. I'm going to put on screen. And then we're going to divide that by 272. We got a 5.5% return. How insane is that? That is gangbuster returns. That's stupid money. That's ridiculous. 5.5% in 10 days? Are you kidding me? That is the difference between a more volatile stock. The implied volatility is a whopping 66%. Now that is a real covered call premium that you can collect. That is wild. Okay, absolutely wild. Now let's take a look at the January 9 1 month expiry, okay? And we're going to use the number here 294. So 294.35 divided by 272, we get 8.2% in a 30-day period. So it's not going to scale 5.5 to over 10, but it's going to be 8.2. And you get to lock that in. The benefit of locking in something ahead of time is nice, because if you lock it in ahead of time, right, then if the stock ends up going down, look, you won't be able to do the 275 strike price in the future, right? That's not how it works, because if coin goes down to 250, for example, you're not going to be able to do 275 in 10 days after expiry. Now, that's probably not going to go down to 250 in 10 days. But you see what I'm saying? Going back to this option, if coin were to fall down a bit, the 275 is not going to be worth as much. So yes, although it's 5.5% today, if coin were to go down to 65, okay, 275 is not going to be worth as much, right? Because the further down it goes, the further out you get out of the money, the lower the premium is, right? So it's going to be farther away from the current price, and that's going to be a reason why it's going to be worth less. So it can be very advantageous to lock in the premium ahead of time, collect that income, and just hold on to that income ahead of time. And that's what I tell a lot of students when I work with them. I'm like, hey, how do you feel about making money today, but having a little bit of risk in 10 to 14 days from now? Do you feel comfortable with that, or do you want to just lock things in right now? And oftentimes I've realized that a lot of people, although they want to grow aggressively, they do want that safety. So that's why 30 days is the magic number for me that I do use oftentimes for expiration. So the beauty of the covered call strategy is I just let it expire. If it stays below your strike price, great. Even if it goes down, that's not really an issue, because if it goes down, it was going to go down anyways, right? And if you just had the stock, then you would have lost more money if you didn't sell a covered call, right? Now that you have a covered call, if it goes down, you have some cushion, you have some premium that you've collected. So that premium is naturally going to decay. So you're going to be making money as the decay happens. There's not much management needed. That's why I love this strategy for the Retirement Academy. If the stock runs really hard upwards, then it's not a failure. You get rid of it for a higher price. Now, as a gift for you making it this far in the video, I want you to check out this clip from a course that I made. I'm going to share it with you for free here, and it's going to be about stock selection, because selecting the stock on the covered call that you use is as important as understanding the strategy. So let's check out this clip right now about stock selection, and then I'll give you some final tips about executing the trade and profiting from open to close.
You want to pick a good, stable company, a quality stock. Start with large, well-known established companies, often referred to as blue chip stocks. This can be Apple, which I showed you an example of in the beginning of the video. It can be Microsoft, it can be Coca-Cola, it can be Johnson & Johnson, it can even be a growth stock like Nvidia. As long as you don't have more than 10% of your money, this is just a general rule and a general standard, then you should be okay if the company has larger than a $5 billion market cap. These companies tend to have very stable growth. They sometimes pay dividends. Even Nvidia has a small dividend, but they don't have to pay a dividend. All that you're looking for is a company that is profitable. It has a PE ratio. Companies that are not profitable don't have PE ratios because they don't have any earnings at all. You want to pick a company that has a price earnings ratio, and the lower that price earnings ratio, typically the better. However, be careful, because not all stocks are the same and not all PE ratios are the same. So sometimes you'll look at a stock like Nvidia. Here you can see on the screen that Nvidia has a high PE ratio. It doesn't mean that Nvidia is a bad stock. It just means that it has a lot of growth. Investors expect a lot of growth, and therefore a higher PE ratio is justified. You do not want to run the strategy on highly volatile or speculative stocks that could tank or basically be very unpredictable. That's because if you want safe, steady, passive income of $8,000 a month very consistently without having to experience the highs and lows, the highs are fun, but the lows are definitely not fun. If you want to actually retire just on this strategy, which I think is very possible, especially if you have a portfolio that you scale to 6 figures and beyond, then you want to focus on blue chip stocks. You want to focus, again, on companies that are S&P 500. Okay, and ideally the top 100 stocks. So Tesla's a good example. Also, stocks like ExxonMobil, okay, oil and gas companies, they can also be viable picks in your portfolio. You don't want to run this strategy on highly volatile stocks that have poor brands, poor cash flow, lots of debt, okay?
Executing a covered call is straightforward. Where most people get stuck is choosing the right stock consistently. That's why I wanted to show you that clip of stock selection. Managing positions month after month is pretty easy when you have the right stock selection. Knowing when not to sell a covered call, again, is very important. And that's where rolling comes into play. You can roll an option by closing one and then rolling it to a higher expiry and a higher strike price. I'll talk about that more. Again, if this video gets 100 subscribers, I'll make that the next video. Stock selection and covered calls is a core concept that I teach and I love for generating consistent income. And that's exactly what I built in the Options Retirement Academy. Inside the Academy, I show you how to select stocks specifically for covered calls, how I adjust strike prices based on volatility, how I manage positions through different market conditions, and how this fits into long-term income portfolio design for consistency. I'm not teaching theory, I'm teaching reliable income and capital preservation. Allow me and several other coaches on my team to help you generate consistent income. Join us with a free consultation to learn more about optimizing your portfolio, and you can check out all of those details in the first link in the description. Thanks for watching, and I will see you in the next video.